Hey, what's happening, everybody? Pete Olinto back with you. Our next exciting topic, fixed income. So this is going to be a strength for you. A lot of easy points here. It's in all three levels. So let's not only eat up the points in level one, let's set a good foundation for what we'll be doing in levels 2 and 3. Okay, some of the questions in fixed income are basically just terminology, definitions. Won't spend a lot of time on that, but certainly easy points. You're not writing an essay, so it's about a game of recognition rather than memorization where you got to regurgitate something in an essay. So not so bad. So the first thing we'll talk about are the features of fixed income securities and then the contents of that bond indenture, fancy word for the bond contract between the lender and the borrower. All right, so our first practice problem we have here, we've got a German emerging technology company focusing on manufacturing process design. They've developed several valuable patents, so they got a lot of intangibles. And if they were internally developed, probably not much in terms of the balance sheet, right? The book value. So it's related to micro machining and metal 3D, whatever. All right, so it gets its revenue through licensing royalties and consulting services. So they issued. So the word issue means you are the borrower. So there's going to be a financing inflow. They're raising capital with this debt instrument. So here we go. So we got the name of the company, settlement date, maturity date. So we've got 4 years now, very important. So N is equal to 4, but I want to be mindful of how often we're paying the coupon. So the first thing I'm doing is scanning. How long are we paying the coupon? We're paying it quarterly. So 4 times per year. So actually 4 times 4, 16. That's our number of periods, okay? Number of quarters. All right, let's see what else we got. Principal amount, $250 million. All right, our interest rate is variable. It's the market reference rate. Now, that used to be LIBOR, okay, but now the market reference rate, so variable rate plus a credit spread of 250 basis points. So that is our credit spread, and that is generally fixed at initiation. Fixed at initiation. So you got to understand how variable debt, how that works, variable rate debt, okay? So the yield, so when you have variable rate debt, the yield varies with changes in the market reference rate, generally not the credit spread, all right? So we know when you have fixed rate debt is that required rate of return goes up. What happens to that price? It comes down. So if the coupon is fixed and it does not change, we know there's an inverse relationship between price and yield. Now, when you've got variable rate debt, and if that market reference rate goes up and the coupon can adjust, well, then all of a sudden that price is going to stay close to what? Par. Okay, but that adjusts with the market reference rate. Okay, not necessarily the credit spread. So you got to be mindful of that. Okay, so what's changing? All right, so the credit spread, unless you're told otherwise, fixed at initiation. All right, the notes are secured and unsubordinated. Now, when you're subordinated debt, you've got to wait for senior debt to get paid before you. That increases your risk, and that should increase your required rate of return, but it's unsubordinated. Now, it's secured by what? Obligation of AG and will rank pari passu. Oh, a nice French term there. What does that mean? Treated the same, as if I could speak French. I could barely speak English. So treated the same, all right? So it's not subordinated to anything else. And regardless of when the debt was issued, okay, pari passu means treated the same. You don't have to wait for somebody else to get repaid just because they lent the money first, okay? Now, when we talk about here secured, this is not asset-backed, okay? When we talk about asset-backed, generally there's a variable interest entity, a special purpose entity, assets, credit card receivables, automobile receivables, whatever it is transferred to another entity that uses that as the collateral for a loan. So they're going to issue those securities. They're going to get cash in return. And then whoever the lender is, the investor, they'll get their principal and interest over time. This is not that type of security, okay? When they talk about secured by what? So it's not asset-backed, okay? Legal claim on assets. If this company defaults. They have a legal claim on the assets. Okay, so, and that's secondary, okay, in terms of the source of repayment. They should be repaying the interest and principal from the operating cash flows, okay, or maybe they're going to refinance, whatever the case may be. But they simply have a legal claim on assets, and that is secondary. That legal claim on assets is secondary in terms of the source for repayment. We're hoping they don't have to liquidate their PP&E, their patents, to generate cash to repay the debt. So remember the balance sheet. Liabilities have the first claim on the assets. The equity has a secondary claim, okay? That's that residual interest we spoke about in financial accounting and reporting. All right, so if there are specific assets that are pledged, okay, as security, that's what we mean by asset-backed, okay? So look for those situations where it's some type of receivables or whatever. We'll get there later. All right, so we're all set up. Let's see what our first question is. The 4 years, that's our time to maturity, okay? And then the market reference rate plus 250 basis points, that is going to dictate the coupon, okay? That will dictate the size of the coupon. So the 4 years is our term to maturity. Now remember, since it's quarterly pay, when you enter your information, that's 4 years times 4 payments per year. That's 16 quarterly payments, okay, when we find the value of this debt. But that's going to be our time to maturity and our coupon rate, okay? The coupon frequency, that was quarterly. That's not stated here, okay? The coupon frequency, that was quarterly. And by the way, what's your current yield? Whatever that annual coupon is, divided by the bond price, you'll see later on, that's how we get that current yield, okay? Don't forget, folks, your yield to maturity is that single discount rate that sets the sum of the present value of the future cash flows, the coupons and principal, equal to the actual price of the bond today. So the yield to maturity is the bond's internal rate of return, which aggressively assumes every coupon could be reinvested at that initial yield, okay? So just some basics there. Which of the following statements best describes the sources of repayment? So the primary source should be the operating cash flow. The secondary source are the general assets because it's secured by the general assets. It's not asset-backed. Okay, asset-backed securities. That's when look for a special purpose entity, a variable interest entity. The company that ultimately wants the funds is going to transfer those assets to a separate entity, then that holds those assets as the collateral, okay? When they raise funds, whoever's supplying the funds, the investor, the lender, they know that in the event there's a default, they have those particular assets that they can seize and use that to pay off, hopefully, the loan, okay, depending upon the value of the collateral, all that kind of good stuff. That's not what we have here. Asset-backed securities set aside, again, could be credit card receivables, it could be accounts receivable, sometimes the specific assets, it could be inventory, or it could be PP&E, or pledges collateral. Okay. The notes rely on the operating cash flow as their sole, not their sole source. That's their primary source of repayment. But in the event there's not enough operating cash flow to service this debt as it becomes due, then they have a legal claim on the assets. That's the secondary source, okay? So the operating cash flows are the primary source, not the sole source, okay? The legal claim on assets, and this ties again to the balance sheet, legal claim on assets in the event of a default, that is the secondary source for repayment. So, as a general rule, the first claim on assets, the creditors, the residual interest, that is the equity. And generally, the preferred equity gets their money back before the common equity.